This class is concerned with the product portfolio strategy. Specifically here we're going to be looking at the Boston Consulting box. This is quite a famous little bit of thinking in the strategy area, and it's important you become familiar with it and the language it uses, the terminology it uses. As you'll see, it has particular ways of describing certain types of business. Now, the company is made up from its subsidiary businesses, its products and its assets. So the company is made up from any subsidiary businesses. The company obviously is made up from its products and its assets. That's how we see businesses. We see businesses in the context of what they make and the assets, the factories, the premises, the fleet of lorries it uses or whatever. We see the company in that way. So it's made up from those components. The best business portfolio is one that fits the company's strengths and helps exploit the most attractive opportunities. So it's a question of the business reorganizing its portfolio of assets in a way that generates a better return on the assets. So the business may have too much cash in the bank. Perhaps it would earn a higher rate of return if it was invested in holding raw materials, which may be appreciating in value. Or it may be better if it invested in new distribution facility or new machinery or whatever. So the business has to look at each of the components, its products, its assets, its physical assets, its financial assets. It has to look at all of the resources of the business and reallocate them in a manner that yields a better return. So the company must decide where to invest and the amount of the investment. That's the decision. Where should the company place its resources, and how much of the resources should it place in particular activities? Now this will be based on the current business portfolio and the opportunities in the market. So it will be determined partially by what the business is currently doing, but also the opportunities that it sees in the market. So it may make a decision to invest in a different part of the market if the return, or the perceived return, the imagined return, justifies that. It needs to decide on the composition of the product range in the light of market trends. It needs to look at what products it's making and look at what's happening in the market. Look at what the fashions in the market are. Look at what customers want. And look at the variety of products in the market. Look at what competitors are doing. Look at product innovation to see if the product can be changed and modified to more precisely meet customer needs. So the business is constantly reviewing its portfolio of assets to try and tweak them to get a higher rate of return, and also tweak the product range so it's more contemporary, it's more up to date, it's more in line with what is expected in the market. Now there are two planning methods we can look at. The first one is the Boston Consulting Group, and the other is the General Electric or Shell model. Now in this case we're going to be focusing in on the Boston Consulting Group. So the focus of this class is on the Boston Consulting Group. Let's start by identifying the strategic business units in a company portfolio. So before we get into the Boston Consulting Group properly, I think it's necessary to be familiar with the language here. And the language talks about the strategic business units, the SBUs. An SBU is a unit of the company that has a separate mission and objectives, and that can be planned independently from the other businesses. So an SBU is a unit of the company that has a separate mission, has a separate set of objectives, and therefore it can be planned independently from the other businesses. And that's what we mean by a strategic business unit. It has a separate mission. It is distinguished from the main business insofar as it's aiming to do something else. It can be a company division, a product line, or even individual brands. So the strategic business unit can be a division of the business, and that's the way we normally think of it, in fairness. We think of it as a division of the business, the strategic business unit. Now let's look at the Boston Consulting Group box. This has two axes. It has market share along the top and market growth along the vertical. On the horizontal axis, relative market share. This serves as a measure of SBU's strength in the market. It's a measure of the strategic business unit's strength in the market. So this is going to apply to a strategic business unit, a division, if you like, within the business. And it's going to look at the relative market share as indicated along the horizontal axis at the top. The vertical axis, the market growth rate, this provides a measure of market attractiveness. So you have market attractiveness on the vertical and market share along the top. The four areas represent four types of strategic business unit. They have somewhat strange names, but quite common names in business. They're called stars, question marks, dogs, and cash cows. And what we're going to do in the remainder of this class is just explain what each of these means. So we'll start with stars and explain what a star is. Now just look at the slide for a moment. You'll see it's got high market share and high market growth. Well, high market share and high market growth both sound good. So stars are high growth businesses. They've got high market share. We'll read these off the axis. So we have two parts of the box, the diagram indicated by high growth businesses and high market share. They may need substantial investment to sustain their growth, but stars are the high movers, the high growth rate and high market share. They may need significant amounts of investment to stay that way, but they are the star performers. When their growth slows, but they maintain their relative market share, they become what's known as cash cows. So when their growth rate does slow down, but they continue to hold their market share, then they become cash cows. So in terms of the diagram, or not the little chart, the matrix, if you like, we've dropped from high market share, high growth, down to high market share and low growth, which gives us cash cows. Now cash cows are low growth businesses, relatively high market share. These are mature, successful businesses with relatively little need for investment. Cash cows need to be well managed for continued profit. So a cash cow is simply a low growth business that has relatively high market share, and they tend to be mature and successful businesses with relatively little need for investment, but they need to be well managed for continued profit. Next, question marks. It's a strange category to classify firms as question marks, but we'll see what's meant. First of all, we'll see it's high growth and low market share. In other words, this one could go to a star if it increases its market share. But likewise, if it loses growth, if it stops growing, it could drop down to what's known as a dog or dogs. So let's look at question marks and see what's meant. Question marks are businesses or products with a relatively low market share, and also high growth rates in the market. So low market share but growing fast. They have potential, but they may require substantial investment in order to grow the market share. So with extra investment, they could become a star. Management must decide which product with these characteristics to develop, hence the term question marks. So products that are have a low market share but at the same time are growing fast, the managers of the business must decide whether those products should be fostered, should be invested in, or just allowed to grow as they are. There's a question mark. And if we go back to the our pictorial view of this, the matrix, as you can see, it could, if market share increases, it could go to a star. On the other hand, if its growth rate falls, then it could become pretty much a disaster. Let's move to the next one, which in fact is this idea of dogs. And these terms are used, so it's important to become familiar with what's meant by them. We do refer to particular products as question marks, or as stars, or as cash cows, or whatever, as dogs. Dogs are businesses or products that have low relative share in an unattractive and low growth market. So it's got a low share of a low growth market. Dogs may generate enough cash to break even, but they are rarely, if ever, worth investing in. So they're not something that the business management would want to commit a lot of resources to. They are low performers, low market share, low growth rate. They just perhaps break even or produce a small surplus for the business. Now, conventional strategic thinking suggests that there are 4 possible strategies for each strategic business unit, for each SBU. First of all, build share. Here the company can invest to increase market share, for example, turning a question mark into a star. Well, that involves investment. It's one possibility. Next is called hold. Here the company invests just enough to keep the strategic business unit in its present position. It just invests enough to keep the product, let's say, in its current position, whatever that position is. It could harvest. Here the company reduces the amount of investment in order to maximize the short-term cash flows and profits from the SBU. So it reduces the amount of investment in order to maximize short-term cash flows. This may turn a star into a cash cow because the growth rate has been reduced. So it takes away investment from the product, from the strategic business unit, takes away investment and turns it into short-term cash flows and profits. So it's harvesting. It's taking resources out of the product or out of the SBU. And the last one is divest. Now, the company can divest the SBU by phasing it out or selling it in order to use the resources elsewhere. So, for example, the company may look at a product and think it doesn't want to produce it anymore, so it divests itself of that product. If you like, it sells off the product. It clears out the product, creating more capacity, more resources are available then to be rechanneled into other products which are deemed more appropriate. So it tries to sell it off. So, and it invests in more, perhaps in the question marks. The question marks could then perhaps grow more or have a greater market share. So the question marks become perhaps turn into stars. So these are the four possible strategies that may be used in the context of SBU. This concludes our talk on this topic. It's really just looking at what the matrix suggested and talking about the four types of SBU that are possible under that matrix, and then looking at the strategies that are available for dealing with the SBUs at the very end of the class. It's an important topic because the language of the topic is used widely in business, and it's important to know what each one of them means and look at what strategies may be deployed to move from one category to another, to move from a question mark, for example, to a star. But that's all I'm going to do in this session, so I'm going to leave it at that and say thank you for watching.